And this year has quite a few twists and turns. But Jyotivardhan Jaipuria of Bank of America Merrill Lynch joins in to talk about that. Hi Jyoti, a very happy new year first to you and your team. So many of your peers are going in quite optimistic to 2014 and what they expect to see from the market. How are you guys calling it, and what do you think it will be a function of? Some kind of performance improvement on corporate earnings, or is it a tactical call if you are positive on the market?
Our view is that it probably may be a better year than the last few years, and that's led by 2-3 things. One is, we've seen the economy do badly, so I don't think the economy is going to turn for this year, but it probably is not going to get worse because we are close to lows. We are growing at like 4.5% on GDP. Some of the macro problems which we had last year may ease off a bit, especially like the current account deficit has definitely eased off. The hope is that maybe, inflation probably starts to ease off a bit. At least we'll not have rate increases. The issue is how fast we can see rates getting cut. And third is finally, we have elections, so we probably will have a better reform environment once the elections are out of the way, simply because you have a new government which comes in. They don't have to worry about elections for the next few years. So I think, there's a lot of hope which is there in the market. One thing is certain, the economy is not really going to turn around in a hurry. It's going to be a very slow process, whatever government comes and whatever macro factors we have. So overall, it's a year where we are looking at like a 10 to 12% return in the market, but not like any big bang return. The hope is that by the end of 2014, we would have built a base which makes us more optimistic that 2015 and 16 will be good years for the economy, good years for earnings, and so, good years for the market.
Hi Jyoti, what are the key risks you see for 2014, and what kind of downsides are you mapping from here on? Where is the market supported, and in the case of some of these bad things panning out, what is the limit of the extent of downside that you can project for this year?
So if we start with the globe is having a change in the way it's going to work. So last 5 years we've been in an environment which have been very high liquidity and very low growth. 2014 probably marks a change where the liquidity is going to ease off relative to what we've seen in the last 5 years. Hopefully the growth will be better. So, there's a change in environment. From India's point of view, again, both of these things will impact us because the lower liquidity means maybe flows won't be as easy to come. You probably need to do that bit extra to attract money to India. At the same time, a better growth environment globally means at least, our exports will have a better chance of growing faster, which in turn will provide a bit of a boost to the domestic economy. Second is, the policy environment, and which probably is dependent a bit on elections. What is the sort of election outcome you have? Up to the election time, generally there's a lot of hope that we'll have a great government. Hopefully that follow-through comes and we start getting that sort of environment improvement in terms of the reform outlook. And third is probably inflation, which is partly linked to where the world is going, but partly domestic food prices, and if that can ease off, then probably it may provide some room for RBI to start cutting rates. But if that does not happen, because generally most people are building that in at the moment, then we could see rates actually need to go up rather than come down, which would provide the third risk.
If you had to bet, and I know it's a difficult one, do you expect the kind of gains you're talking about to be front-loaded in the run-up to the elections? Because sometimes pre-election periods tend to be good for the market. Or do you expect most of the gains to come in the second half, post-elections, and when there is a slight hope that growth or earnings are beginning to pick up?
My view is that a lot of the gains may be front-loaded, but what we've been calling for very tactically is that we'll see a correction in the early part of the year. So, like if you look at markets, typically November, December are great periods. From the lows, we've seen markets up nearly 20% in the last 4 months. So, tactically, we've been saying that Jan and Feb will probably see a bit of pullback in the market, which offers an opportunity to buy. In the run-up to elections and around the election result date, we'll probably have markets which are good. So if you look at history of the last 6 elections, in 5 of them we've seen a pre-election rally. Markets have given an average return of 15% from 6 months before election to the election result day. So I don't think this time is going to be different. I think we are going to see that sort of hope rally coming through up to the election day. and then it will be like what sort of elections results play out. But even if the election results are in line with market, or at least market believes it's favorable to the market, we'll probably see the rally happening very close around the election result time.
Jyoti, you guys constantly do, dipstick surveys in terms of how the flows are moving. Anecdotally, do you hear any evidence that 2014 is going to be radically different in terms of, the kind of interest that flows have given to emerging markets? Are you hearing people making a lot of shifts because of all this taper talk?
Okay, so the current sentiment seems to be that people are preferring developed markets and they don't like emerging markets as much. So if we look at most of our fund manager surveys over the last few months, they've always been very underweight the emerging markets and quite overweight the developed markets. But quite often this is not necessarily what will plan out through the rest of the year, because this is like the current sentiment, and it's the way markets have worked. So if you see last year, the developed markets did very well, the emerging markets relatively did poorly, and so most people are positioned to have that trend continuing into 2014. The other thing one must remember in emerging markets is there are like 8 elections this year in emerging markets, so there's a lot of politics which is going to be one of the factors in markets throughout in 2014.
So Jyoti, how are you positioning your portfolio for 2014? I mean, if you had to pick, what would be your top 2 or 3 sectoral overweights and top 2 or 3 sectoral underweights going into the year?
Yeah, so if you look at our overweights, they're in some sense a mix of what has done well over the last few years and what we think will do well as the economy slowly starts to recover. My view is the stocks may move much ahead of the actual recovery in volumes or in earnings coming through. So like we are overweight autos, that is one of our big overweights, and the whole logic is slowly as we see the economy start to recover, stock prices will move up much faster than the recovery in the economy. But we are still overweight pharma and overweight software. Those are 2 sectors which have done very well over the last few years, and that in some sense plays the taper fears also, that if we get taper starting to have an impact and the currency tends to depreciate a bit, you are into 2 sectors which will do well. What it also plays to some extent is that US is going to recover in terms of the economy, so probably IT is the best way to play that. Apart from these 3 sectors, we like the telecom sector, and we actually overweight energy on the hopes that oil reforms will continue. Once we get a new government, they'll probably accelerate, and that will be a trigger for oil. What we don't like, so one of our biggest underweights is consumer staples. So that's a sector which has done very well over the last few years, and we underweight that sector partly because it's got played out, valuations are not very cheap, and to some extent that's where earnings may start disappointing a bit on the margin. So what we have done in some sense is taken some sectors which did well over the last few years and underweighted them and kept our overweight on some of the other sectors. We also underweight on metals, which is more like a global call. We don't think really China is going to be a big buyer of metals. They're shifting their whole growth profile more to consumption, and so that's another sector which we are underweight on.
Jyoti, always a pleasure. Have a great 2014. Thank you very much for dropping by today.
Thanks.
That's Bank of America Merrill Lynch on how they read the year. But